Top 5 Moving Average Signals. Top 5 Moving Average Signals. How to make money on the simplest indicator. Good day. Within the framework of this article, we will consider one of the oldest, reliable and objectively useful indicators of technical analysis, moving average, or in Russian, moving average. At the moment, there are a large number of varieties of moving averages. Its simplest version is considered to be the reference one, simple moving average. The formula underlying the indicator is calculated by finding the arithmetic mean within a given set of values. For example, when calculating a simple moving average with a 20-day period, you need to take the sum of the closing prices of daily candles, or bars for the last 20 days, and then divide by 20. The 100-day moving average is calculated according to the same principle, only in this case will be used data for 100 days. In trading terminals, this indicator is most often displayed as a line superimposed on the price chart. Indicator setting. As can be understood from the formula above, the only adjustable parameter of the moving average is the period. The shorter the period is set in the settings, the more sensitive the movements of the moving average become in relation to price changes. With an increase in the period, its sensitivity becomes weaker. There is no ideal period for earning money, you can only find the best one experimentally. Moving averages are an easy way to average price movements over a given period. Exponential moving average. The exponential moving average is a modified version of a simple moving average. It reacts faster to changes in value and better tracks trend direction. The essence of the modification is to assign weighting factors by adding the exponential method to the main calculation formula. The EMA concept was first introduced by Charles S. Holt in his 1957 article Forecasting Seasonal Trends and Trends Using Exponentially Weighted Moving Average. Already in 1960, the EMA was used as an indicator for tracking and analyzing changes in stock prices by P. Kurlan. What is the difference between EMA and SMA? When calculating a simple moving average, all prices of the selected period have the same weight. When calculating an exponential moving average, recent prices are of great importance, due to which this type of moving average is more sensitive to changes in recent prices. The main function of the moving average in technical analysis. First of all, the moving average is used by traders and investors to determine the direction of the trend. The principle of operation is as follows. A moving average is superimposed on the price chart for a certain period. For example, 50, these are 50 previous days. If the price chart is above the moving average line, the trend is upward. If below the moving average line, the trend is downtrend. The direction of which trend, short-term or long-term, is shown by the indicator depends on the selected period. If a small period from 1 to 30 candles is selected, the moving average will display the direction of the short-term trend. If you set a longer period, from 30 to 500 candles, the moving average will begin to display the direction of the long-term trend. Most often, closing prices are used to calculate the EMA and SMA. However, in most trading terminals, the calculation parameters of the indicator can be changed, due to which, in addition to the closing prices, you can calculate the moving average at the opening rate or price extremes. Let us briefly summarize what has been written above. Asterisk, the moving average is an old, proven indicator. The main task of the moving average is to indicate the direction of the trend. The difference between SMA and EMA is the greater sensitivity of the latter. If a small period is selected, the moving average shows the direction of the short-term trend. If a long period is selected, the moving average shows the direction of the long-term trend. Moving average trading. Trading signals SMA and EMA. The price chart crosses the moving average signal line. In this case, the main property of the moving average is used, an indication of the direction of the current market trend. A buy signal is received at the moment of a possible breakdown of the current trend, when the price chart comes close either from above or below to the signal line of the moving averages. In simple words, if the price chart is above the moving average, it tells us that the trend is up. If the chart is going down, it dives under the moving average. There is a possibility that the trend will change to a downtrend. A bearish trade must be opened at the time of the breakout. If the price chart is below the moving average, and then approaching the moving average breaks it and goes higher, you can try to open an upward trade. Since in this situation there is a high probability of a trend change to an upward one. A moving average with a period of 14 is superimposed on the price chart. At the moment when the price chart crosses the moving average from top to bottom, open a deal for a fall. To confirm the signal, the breaking candle must close below the signal line. At the moment when the price chart crosses the moving average from the bottom up, we open an up trade. To confirm the signal, the breaking candle must close above the signal line. Stop loss. Several points behind the moving average. You can use a trailing stop, take profit. We close the position at the next intersection of the price with the chart. This strategy is reversible. Therefore, instead of take profit, you can flip the position in the opposite direction. Pros, asterisk simplicity, minuses. It works well only on a trending market. A lot of false signals appear in the sideways. Moving average crossover. Above, we reviewed the trading method based on one moving average. The method that we will consider now involves the use of two moving averages. The essence of these strategies is the same, finding the point of trend change. The difference between them is that when moving averages cross, instead of the price chart, a second moving average with a shorter period is used. In simple words, two moving averages are superimposed on the price chart, fast and slow. Their intersection indicates a possible trend change. To implement this strategy, we need two moving averages, fast and slow. I personally use period values of 20 for fast and 38 for slow, putting both movings on the chart. At the moment when the fast moving average crosses the slow one from the bottom up, we open a long trade. At the moment when the fast moving average crosses the slow one from top to bottom, open a deal for a fall. Stop loss. At the level closest to the intersection of the local price low or high, take profit. Next moving average crossover. Pros: simplicity. Gives fewer false signals than a single moving average strategy. Minuses: very lagging signals. The trend has changed long ago, and the movings have just crossed. When opening with a gap, false signals very often slip. Support or resistance levels. This method involves the use of moving averages as dynamic support and resistance levels. Its essence is quite simple. A moving average with a period of 200 is superimposed on the chart. This period is used most often, but you can use any other at your discretion. Next, you need to wait until the price chart touches the moving average. But unlike previous examples, at the moment of touching, we open a deal not for a breakout, but for a pullback from the signal line, short if the price touched the signal line from below to the top and long if the price touched from above to below. In this case, the moving average works on the same principle as the usual support and resistance levels. A moving average with a period of 200 is superimposed on the price chart. At the moment when the price chart touches the signal line from top to bottom, the moving average acts as a support level. We open a long trade. At the moment when the price chart touches the signal line from bottom to top, the moving average acts as a resistance level. We open a deal for a fall. Also, moving average support and resistance levels can be combined with regular price levels or Bollinger Bands to achieve a synergistic effect. Stop loss. At the level of the nearest local price minimum or maximum, take profit. The nearest significant horizontal support or resistance level. Pros: simplicity. Together with price levels, the strategy or BB gives a good result. Minuses: *A. Reference period of 200 is not always effective. For each instrument, it is necessary to select its own working period and periodically change it depending on the market phase. 100% moving average discrepancy. This method is based on the cyclical market movement postulate. Its essence is simple: the more the price deviates from its average values, the higher becomes the probability of a reverse reversal. Our task is to determine the area within which a reversal is most likely to occur. Strategy work scheme. The already familiar moving average with a period of 200 is superimposed on the chart. Next, you need to determine the extreme local minimum and wait for the price chart to approach the moving average. Then mark the distance between this price low and our 200th moving average. If the price continues to rise in a distance equal to or greater than the distance noted by us earlier passes from the breakout point of the moving average, we can expect a quick exhaustion of the trend and the subsequent reversal of the market. You can read more about this strategy in the article, How to Determine a Trend Reversal. 7 Signs of a Trend Reversal. Stop loss. Beyond the extreme, take profit. At the level of the moving average. Pros: high efficiency. Minuses: compared to previous strategies, it is slightly more difficult to perceive and apply. Moving average corridor. This method is very similar to the strategy in which the moving average is used as support and resistance levels. But, in this case, not one moving average acts as a support and resistance level, but a corridor created by two moving averages. Strategy work scheme. We impose on the chart two moving averages, a fast one with a period of 16 and a slow one with a period of 28. These are the periods that I use. You can change them and adjust them to suit you. Next, you need to wait for the moment when the fast moving average crosses the slow one from bottom to top and a corridor begins to form between them. At the moment when the price chart enters the corridor from top to bottom, we open a long trade. At the moment when the price chart enters the corridor from bottom to top, open a deal for a fall. Methods for entering a trade. 1. A set of positions with one deal. The entry is made with one trade when the price chart reaches the middle of the corridor. 2. Set the position in parts. The position is gained in parts as the price moves within the channel. If the price does not touch some orders, then we get the rest of the position already at the exit of the price from the corridor. Stop loss. Several price points away from the slow moving average. Take profit. Close the position at the moment of crossing the moving averages. Pros: high efficiency. Minuses: high quality signals appear quite rarely. The moving average corridor is one of the few indicator strategies I use in my trading. A really effective strategy, so take a closer look at it. How to set up moving averages in MetaTrader 4 and METITRIDER5 trading terminals. Moving average indicator in METITRIDER5. In the trading terminal, create a window with the chart of the instrument you have selected and click on it with the right mouse button. In the menu that opens, select the Add Chart item. After that, the Add Chart window will open in front of you. Find the moving average item and click Add. Moving average indicator in MetaTrader 5. In the top menu, find the Insert section. Click on it. In the drop-down menu, click on the Indicators item. And in the list that opens, select Trend. In the next list, select Moving Average. After that, a window with the indicator settings will open. Carry out the settings and click OK. Indicator added.